So, in a lot of textbooks, the story of how the central bank impacts the economy really relies on the money supply. Now, a lot of this goes back to the history or the monetary history of the United States, written by Milton Friedman and Anna Schwartz, that excessively tight monetary policy by the Fed and deflation during the Great Depression was really caused by kind of malfeasance or kind of inaction by the central bank itself. So this was a theory that the monetarists kind of pushed in the 1970s, really starting in the 1960s. And their theory basically says that money has very real effects. And that's different than a classical school of thought. So monetarists basically imply that money creation itself, the change in the money supply, if it's not the correct amount, that can have real impacts on the economy. So in many cases in monetarist thought, the idea of increasing the money supply at the correct pace would be something that would keep the economy growing at the right speed. And it wouldn't create bubbles, and it would be more of a stable economy. So the Fed, following the Great Recession, was focused on, stimulating the economy. Following the COVID era, the COVID pandemic, the Fed is also focused on stimulating the economy and trying to prevent falling prices or deflation. So when you think about, how the economy evolves, expansion of the money supply at the end of the financial crisis continues for many years. So here we see M1, M2, and currency. And probably the most important measure here is the gold one, the yellow one, M2, because that reflects the more liquid forms of money that we have in our economy. And something that's a little tough to see in this image is that the average growth rate here for most of these, if I just draw a line across at 0, you might be able to see that over time, those growth rates have kind of increased in the post-2008 era. So prior to 2008, you see periods in which, the gold line is kind of closer to this and the blue and green line are both all closer to 0. But following the crisis of 2008, the money supply kind of accelerates its rate of growth. Now, this is happening because the Fed conducts, conventional monetary policy in an attempt to stimulate the economy by cutting interest rates. But they create all these new policies. One is to provide additional liquidity and capital directly to financial institutions. By doing this, they change the nature of their balance sheet. And that's what the Fed's balance sheet, which is kind of flipped around from the private banking system. The size of the balance sheet more than doubles in really the first couple of years following the financial crisis. And there's huge impacts on this. And the composition, so the quality of the assets held by the Fed, is also changed significantly. Because prior to 2008, they really just hold government treasuries. That's the only security they really hold. After the financial crisis, they purchase and hold trillions of dollars of mortgage-backed securities, which is really reflective of what people owe on the value of their home. On the asset side, lending was expanded to the economy. This includes financial institutions and non-financial corporations. So the Fed itself is lending directly to banks, something they are typically doing, but also to non-financial corporations, not something the Fed usually does. On the liability side, following the financial crisis, they didn't really finance additional lending by printing money. The funds came from borrowing from the Treasury and creating banks' reserves itself. So it wasn't the actual printing of paper money so much as it was creating this electronic money. So when we look at the Fed's balance sheet and how it changes from, say, 2007 to 2019, now 2019, this is a period where the Fed's balance sheet, notice, is about $4 trillion. It's about a little more than 4 times the size that it was prior to the financial crisis. And other components of this are that we're really kind of in the drawdown phase where we were talking about normalizing or trying to get the Fed's balance sheet back to the size that it was back in 2007. So you can see here prior to the financial crisis, they're holding about $800 billion in U.S. government bonds. And on the flip side, as liabilities, currency is a liability to the Fed. Reserves, that's a liability to the Fed. It's money that they owe to banks, like banks have money on their account on reserve at the Fed. The Fed then owes them those reserves. The trick here, though, is the Fed can create those reserves out of thin air. Between 2007, notice the amount of treasuries that the Fed holds increases dramatically, in this case by about a factor of 3. But mortgage-backed securities go from 0 to about $1.6 trillion. That's in March 2019. So we're 12 years following the financial crisis, and the Fed's still holding trillions of dollars of mortgages. On the flip side, the amount of currency that the central bank has outstanding nearly doubles, a little more than doubles, and reserves have gone up dramatically. So when we look at that, I mean, the idea here that reserves increased by almost close to 200-fold or more, the previous thought about how the money supply would affect prices and inflation really just dissipates. So that's something that I want you to see here, is that the money supply itself, when we think of the monetary base, M0, which is really just currency plus reserves, that expands dramatically by more than a factor of 4. And yet, prices don't increase by a factor of 4 over that period. So just looking at kind of what happened here in 2008, under the first phase of quantitative easing, QE1, there's a lot of direct lending to financial institutions. That's trying to rescue institutions which are potentially failing because they are not liquid. Now, QE2, this period here, that's more reflective of trying to increase the size of the Fed's balance sheet by, one, buying lower quality assets and creating an additional amount of liquidity for those banks. Think of it like this. I'm a bank. I hold a mortgage-backed security, but it's difficult to sell. So what can the Fed do? They buy a mortgage-backed security and can almost replace it with a treasury on my balance sheet. Now that makes my bank look better from a solvency perspective. So in that case, they're trying to stabilize the economy here. QE3, this is happening in 2012, 2013, 2014. They're still expanding the size of the balance sheet through purchases of mortgage-backed securities as well as government treasuries. Now, in about 2018, this is the period where the Fed is trying to wind down all of the purchases that they had. They're also raising interest rates at the same time. So don't think that the Fed has to withdraw all of these reserves in order to potentially impact the interest rate. The two are really unrelated. One reason is the Fed pays interest on reserves. So I can raise the interest rate that banks lend money to one another because I can set a floor on that by raising the fact that I just pay banks money for having reserves on my account. This is a little bit more, I think, blown up, a little bit closer detail, just to show you the size of the Fed's balance sheet in 2007 was about $870 billion. And then by 2014, it increases to over $4 trillion. So these are huge numbers about how big of an increase. And if you go back and look at the historic data on this, you would see that the Fed's balance sheet grew at a very, very stable rate over decades. So to see it increase at this rate is just phenomenal. So when we think, I've been mentioning bubbles quite a bit here, and I want you to understand here that bubbles themselves, Bernanke, who was head of the Fed, but not in 2000, he argued in 2000, though, that it's often difficult to tell when you're in a bubble. Even if you know it's a bubble, monetary policy, raising interest rates, might not be a good way to fix that problem. So we should use more precise instruments, like requiring banks to hold more capital. If I do that and I reduce the leverage in the system, banks have to be more careful about who they lend money to, and it might reduce the overall amount of lending capacity in the economy. The standards of regulation here are set by the central bank, but none of this really helps us understand what's meant by fundamental value. So when I say there's a bubble, that means really the value of something is departing from what you consider to be the fundamental value. So if we think about home prices in the US, for example, and this is all home prices relative to 1953. So we're on a ratio scale here. So what you can see is like this is a relative constant rate of growth as well as a relative constant rate of decline, subsequent constant rates of growth. So when we look at this, the idea here is that the real home price increasing that dramatically during a short period of time between 2000 and 2008, or 2007 really, and then 2012 and close to today, that might be a bubble. The central bank might be creating a bubble by allowing lending standards to be too lax and allowing credit creation to be too hot. So in the financial crisis, after banks fail, Congress passes what's called the Troubled Asset Relief Program. There was a good movie that talked about kind of some of the economic problems. It was called Inside Job. I think it's an interesting movie for you to watch just to kind of understand, how economists look at solving problems and how potentially money might influence what it is that they would suggest. So the Troubled Asset Relief Program itself is related to the fact that the Fed, via the Treasury, was supposed to buy up a whole bunch of bad assets, things which were failing, to help improve the position and the balance sheet of individual financial institutions. Kind of rather than do this, what they ended up doing was actually buying an ownership stake in many different financial institutions, not just banks, but also things like investment banks and clearinghouses. So these are really important because it really reorganizes these institutions because the government steps in and they own it and they can reorganize the debt in that case, but it creates all sorts of legal issues with respect to who owns the company. Following the financial crisis, there's a lot of fiscal stimulus. That's going back to our aggregate demand line, our IS curve here, the share of potential GDP which the government is spending. That was the stimulus package which takes place in February 2009. It increases the deficit a great deal. Economists largely agreed that this was necessary, but they don't agree on the types of spending. So when we talked about the multipliers earlier, some things have bigger multipliers than others. Tax cuts versus new spending might have different longer term effects, whether it be growth or short term. And there's always this argument about government spending and fiscal stimulus related to Ricardian equivalence, such that if the government increases spending today, you're simply going to increase taxes in the future, and therefore it doesn't really have any aggregate effect. It might dampen that effect. However, it's difficult to see how there's no real effect from a lot of this additional government spending because the consequence has always been predicted that interest rates would rise. The government would do what's called crowd out private investment. We don't see a great deal of evidence that that occurs in the large enough scale to show that there's no aggregate effect of increased government spending. So the CBO estimates short-run output would reach 7.4% gap without a stimulus package. But even with the stimulus package, in its best case scenario, was still that there was going to be a long and deep recession caused by the financial crisis. So going back, politically, whether you agree with any president or not, the President Obama was handed kind of this very large recession at the very beginning of his administration. The stomach at the time for large deficits was much different than it is during, say, even the COVID crisis. People on both sides of the political aisle were very worried about the size of the debt, and there was a big political backlash 2 years into his administration as the debt continued to increase, and that was kind of the birth of what's called the Tea Party, which was related to the issues of trying to increase taxes to pay for some of that additional deficit spending. Now, subsequent to the financial crisis, we have a lot of financial reform. How do we prevent these major problems? You can think of gaining a better understanding of volatile prices and housing and stocks, the markets that would have bubbles. But we think also about the downside of moral hazard. So moral hazard, again, when you have the potential for a bailout or that insurance, you might take bigger risks as a result of having that kind of, potential bailout in your back pocket. That's a problem when there's an institution which can step in. Go back to the idea of rules versus discretion here. If there's just discretion on the behalf of the Fed that they can jump in, that they might do it. Therefore, You're more likely to take bigger risks yourself, knowing that you personally might not be punished. Now, with too big to fail, this is related to the idea of what's called systemic risk, not systematic, yet systemic. Now, when we have large financial institutions, if one of them fails, their failure might cause other institutions to fail, which would cause other institutions to fail. So the argument there was that the government had to step in to try and rescue the economy, because if they didn't, much more of it would have collapsed than had they done nothing. So this brings us to kind of like the idea of macroeconomic research. Did it fail the country? Did we do a bad job? Very little research was available to provide rules for what to do. And the models that we've kind of adapted since then are more advanced. They include things like friction, sticky inflation, limited financial markets. And I've tried to show you, and that's one thing I like about this Jones textbook, is it gives you a flavor as to what was really done after the financial crisis. We've also tried to think more about heterogeneous consumers, so we don't just assume everybody behaves the same. You can think about various consumption patterns, whether it relates to wealth or income. We can also look at imperfections in financial markets and think about other roles for government. So generally, there's been a huge increase in macroeconomic research since the Great Recession. The approach we're talking about here is still pretty much the basic norm of what economists do. Again, it's not as complicated, but it does give you the spirit of how this economic research has moved. So I hope you have learned something from this lecture about kind of pulling together the IS and MP curve to get that aggregate demand, aggregate supply. We're developing the ideas behind a monetary policy rule. And all of those things coming together is really, I think, here to help you understand kind of the frontier of macroeconomics and the way the short-run macroeconomic models work. So please let me know if you have any questions. Thank you very much.